I want to welcome Bill Baruch, president of Blue Line Futures, who watches all of this, and of course some of the macro issues out there, Bill. And I do want to start with what it is you're watching most closely, because there's so obviously we've got the president-elect announcing a new cabinet. That's interesting. I don't know how much that should be priced in, and then the prospects for Congress to get something together before the session ends December 11th. Are you optimistic? What's top of mind for you right now?
I do think that Congress, well, first, thanks for having me on. I do think Congress is really front and center here. They not only need to get a fiscal package, they also need a spending bill to keep the government from shutting down. So as sentiment waffles around that, you're going to see the stock market move accordingly. And right now, I think there was a little cold water yesterday being thrown over the market. Now that a fiscal bill did not have a headline price tag of $2 trillion. Probably going to be something well below $1 trillion, but we could see multiple packages. On top of that, the fact that you're seeing additional, the cases rise in California, hospital beds being scarce, all of that kind of threw some cold water over the market yesterday late. But overall, I love what stocks are doing. They've held very well. Every support level that this market goes back and tests, it's been holding, and there's good leadership at different times. And I think that I think we are heading higher in the market overall. But the market does expect to see fiscal policy, some sort of stimulus over the next month.
So when we look at those new highs, and we're watching, obviously, especially the S&P 500, although the Nasdaq 100 is going to keep our interest as well. From a technical point of view, what are you watching here? I mean, what's the market pricing in, and what does it need to sustain at those levels, above some pretty key levels here?
Yes, there was a close on Monday. So the very near term, 36.23 in the S&P, and then the same accordingly with the Nasdaq 100 futures is 12,277. I want to see price action stay above there, and some early weakness today and overnight held really well against that. There are some bigger support levels below, but as the market continues to try to push higher, there is resistance, obviously, at the previous highs in the Nasdaq that we're trading at still. We did close above yesterday, but still trading at. And then the S&P, there's a rising trend line going back about a year. And, I think those both bring some overhead technical resistance. The Dow psychologically right at 30,000, although it was achieved. So I think all of those, the fact that we're holding so well at and above at times, I think is overall paving a path of least resistance. And then the pullbacks are holding technical support very well. So I like the way this market is. But again, it is pricing in the expectations of fiscal policy within the next month.
So let's talk downside risks then. I mean, obviously there is if you don't get fiscal support in time, and I mean, arguably, even if you do, there is a gap that's still going to have to price itself in. Are you looking for corporate earnings to stumble at all, or is there anything that could show up in the data on employment that could be a setback for these markets, or are we just looking past that and it doesn't really matter what happens in the next few weeks?
Well, the earnings, I think, just to touch on that, is we're seeing the stocks move out of the earnings recession. And that's going to ultimately in 2021, I think a lot of investors are already pricing that in, and how that is going to add to a path of least resistance higher, as well with the Federal Reserve remaining accommodative, and then the expectations of new fiscal measures. But overall, when the market rallied on the news of Pfizer a few weeks back on that Monday morning, there was a big support level being created at 3,500 in the S&P. That is my line in the sand. If we break below there, we could easily see another 5%. But the market's moved fairly well, and lo and behold, we're roughly 5% away from that now. So 3,500 is my line in the sand. As long as we stay above there, I think the market is going to look for a move. And the S&P, maybe 3850 area, we could really see that happen. So I'm not saying that the upside is limited to 3850, but that's my next near-term target.
All right, I want to talk to you about oil, because we have seen it, break out of the summertime range. There's some policy-driven issues happening right now with OPEC meeting and output levels in question. What are you watching when it comes to? I want to look at WTI, if that's all right with you. But what are you watching when you look at this?
Well, there is some really terrific technical setups taking place right now, and I'll touch on that first. although I am cautious, and in my daily newsletter that goes out to my clients, I did take a very neutral approach. We've been bullish crude oil. In fact, we even said to look to buy at $35. Look for that pullback to buy on weakness, tremendous value there. And we're at 45 now. So again, you got to take some profits if you did catch a move. And that's why we're neutral. But today we did reposition. We began to reposition using call spreads, defined risk, using the $47.50 February call spreads. We bought those for around $850 a piece in the futures. But overall, that's because of the technical setup in the market. There's a tremendous bull flag building as we're holding out above the previous swing highs through the summer in crude oil. So as long as that holds, I think the path of least resistance higher. But listen, you need to manage your risk. You need to place, if you're going to be long crude oil, you want to have defined risk trades here. And really the reason being is OPEC is going to give us a decision tomorrow. What are they going to do? Are they going to delay the production cut taper for January 1st? That was initially having, I think, 1.9 million barrels supposed to be on the market. Now, that production cut taper was expected, 100% expected, already priced it in the market. Mm-hmm. But on Monday and Tuesday, we got word that the UAE wants to present 500,000 barrel ad with the backing of Russia. So you're starting to see this rift within OPEC. And that worries me because we've seen it before where Saudi Arabia starts to see others kind of want to do what others want to do. And then Saudi Arabia says, we're going to turn on the taps. They did that in March. So to the downside, that would be catastrophic. I think in the near term, we could see a big plunge in the market, even breaking $35 if something like that were to happen, given the current expectations and given what there is, let's be honest, there is an uncertain timeline out there of when vaccines are going to arise, or they get delivered. Right. And then as well, where we're going to be on lockdowns, state and local lockdowns. Some of that stuff is still much uncertain. And that is a question to the demand landscape for crude oil.
So all of that in the mix, those people who are long energy stocks, of course, shuddered a little bit when they hear you say 35. One place that, there's some real believers and they remain believers are those investors in gold who see it as sort of not just a safe haven these days, but a hedge against all kinds of issues that could be ahead. Where are you on gold, and in terms of the levels that it's sitting at, what are you watching?
Well, just to go back real quick, you mentioned energy stocks and those long energy stocks. I am long energy stocks. Mm-hmm. I have energy stocks in portfolios. I own Chevron. I bought Chevron yesterday, added to a position, Pioneer, as well as Marathon Petroleum. I like what I'm seeing in these energy stocks. And listen, it's all about position sizing. I am adding to positions within a portfolio mandate, or I'm trading crude oil and my futures with the mandate of defined risk. So as long as you have a good plan mapped out, the path of least resistance is to the upside. Don't get me wrong on crude oil. I like the way we're seeing the market move. But shift over to gold. I think we've seen a really good rebound in gold here today, and that's undeniable. But where we were last week, it was a tremendous. The landscape just really was a cleansing. It needed a cleansing. I mean, we saw gold break below a big support level, 1845, 1850. Options expiration was Tuesday, and we went down to 1800. It was a magnet down there in the options expiration. And then the December futures contracts, they expired, and that created more of a flush. The market is cleansed out. We can now begin the bottoming process. I am very hopeful for gold, and especially the fact that the U.S. dollar is breaking down. The U.S. dollar is breaking down through a big level if you're looking at the dollar index. Mm-hmm. And then the Chinese yuan against the U.S. dollar has a lot of room to the upside to run. All of this is supportive to gold. And I ultimately think that 1770 was a big level that held for gold, too. So the technical landscape, although there is some damage, we're starting to repair that. What I want to see is this chop around in a healthy way. Above 1800, above 1809 is very good, and that happened today. But we do got to close back above 1845, 1850 in order to start that repair from all that damage.
Bill, it's always great to have you with us. Appreciate it.